People often say that the average millionaire diversifies their income across approximately 7 different sources. In contrast, most individuals rely solely on income from their job, leaving them vulnerable to financial instability. Examining the habits of millionaires reveals a pattern of multiple income streams. However, not all income is equal. It varies in terms of activity level, passivity, taxation, and leverage potential. Today, we'll check out the 7 main ways that most millionaires earn money. Before we begin, kindly give the video a thumbs up and consider subscribing to our channel so you won't miss out on more awesome content like this. Let's get started. The first and most common source of income is earned income. This includes money earned from jobs, from regular workers to big bosses like CEOs. Even many CEOs remain employees of their respective companies. Professionals such as doctors and nurses also fall into this classification. Earned income is acquired through exchanging time for money, commonly referred to as active income. This category may also include freelancers. For many self-made millionaires, earned income serves as the initial stepping stone. It's where most people begin and can be a solid foundation, especially if it enables one to provide for oneself and their family. But it's risky to depend only on this kind of income because it means you're trading your time for cash, which is limited. With only 24 hours in a day like everyone else, there's an inherent limit to how much can be earned in this category. Moreover, earned income is subject to high taxation rates, sometimes reaching up to 40% of earnings, depending on income levels. While it's a commendable starting point, it's crucial to explore other income avenues available. The second stream of income is profit income. This refers to income generated by selling goods or services at a price higher than the cost of production or acquisition. It marks a transition from being an employee to becoming an entrepreneur. In the past, starting a business needed a lot of money for making or buying things. But now, with the internet, it's much easier to get started without needing as much cash. Whether selling physical or digital goods, if the selling price exceeds the production or acquisition cost, it yields profit income. This income type can be either active or passive, depending on the business model. Engaging in manual product creation and sales leans towards active income and may pose scalability challenges. Conversely, outsourcing manufacturing or focusing on digital products opens avenues for passive income potential. Profit income can be categorized into 2 forms: individual small-scale ventures and highly scalable enterprises. The former involves personal creation or manual flipping of products, such as through platforms like eBay or Facebook Marketplace, offering an accessible route to supplementary income. In contrast, scalable profit income stems from establishing a business and outsourcing production, freeing up time for strategic functions like sales and marketing. Taxation varies between these 2 profit income types. Individuals engaged in small-scale flipping or product creation typically face taxation similar to earned income. Conversely, establishing a business entity may unlock numerous tax advantages, with the possibility of leveraging corporate structures for tax optimization. The third income category is interest income. Interest income is generated by earning interest on lent funds, but usually it's not a good idea to lend money to friends or people you know. Instead, interest income is commonly acquired through safer investment avenues, such as depositing funds in a bank CD, investing in corporate bonds, or purchasing treasury bills. While these methods offer stability, they often yield modest returns, typically ranging between 1 to 4% annually. Alternatively, there may be more innovative yet riskier approaches to pursue higher returns. Interest income is considered passive, as it typically requires minimal active involvement from the investor. The fourth one is the dividend income. Dividend income arises from investments in stocks that allocate a portion of their earnings to shareholders. When you purchase stock in a company, you effectively become a shareholder. Periodically, usually quarterly, the company distributes a portion of its profits to its shareholders in the form of dividends. As a shareholder, you hold partial ownership in the company, entitling you to a share of its profits. The tax rate on dividend income varies depending on its classification. Qualified dividends may be subject to a lower tax rate. Individuals earning less than $38,600 in ordinary income may incur 0% tax on their dividend income, with the rate increasing to a maximum of 20% for those earning over $425,000. This rate is notably lower than the tax rate on earned income, which can reach up to 40%. Number 5. Rental income. Income from rentals commonly involves acquiring real estate and leasing it to tenants. However, this isn't restricted solely to residential properties. It can include commercial properties leased to businesses or industrial real estate rented to manufacturers. Additionally, rental income isn't confined to real estate. There are alternative methods to generate rental income on a smaller scale. For instance, individuals may lease out equipment for various industries, their vehicles, musical instruments, and so forth. Essentially, rental income refers to any revenue generated by providing a property to someone else in exchange for payment. Number 6. Residual and royalty income. This type of income is about getting paid even after you've finished the main job. It could be from things like being in a movie that people still watch, writing a book that keeps selling, or nowadays, having a YouTube channel that people keep watching. Royalty income represents a form of residual income, garnered by permitting others to utilize one's ideas or properties for profit, such as music or literary works. For instance, musicians permit streaming services and recording labels to distribute and sell their creations, thereby earning royalties each time their music is played or sold. Similarly, authors receive royalties when publishing companies print and distribute their books, continuing to earn as long as sales persist. Furthermore, multiple streams of royalties can stem from a single property. A notable example is author J.K. Rowling, who not only earns royalties from her book sales, but also from adaptations of her work into movies and merchandise featuring her characters. Even 2 decades after the release of the first Harry Potter book, Rowling continues to receive royalties whenever individuals purchase merchandise, rent or stream the movies, or buy the books, as these products derive from her original creation. Number 7. Capital gains. Capital gains income arises when an asset that has appreciated in value is sold. While real estate and stocks are the most common examples, numerous other assets can generate capital gains. For instance, if you purchased a property for $180,000 and later sold it for $250,000, you would have realized a capital gain of $70,000. Similarly, acquiring 100 shares of a company at $20 per share and selling them at $120 each would result in a capital gain of $10,000. It's essential to distinguish capital gains income from profit income. The former doesn't involve purchasing or producing goods for resale at a profit. Instead, it involves assets whose market value has appreciated over time. While individuals have limited control over this value increase, capital gains enjoy favorable tax treatment compared to most other income types. Capital gains tax rates typically range between 15 to 20%, with the possibility of reducing to 0%, particularly in real estate transactions. In many cases, reinvesting capital gains from real estate back into the market may enable tax-free growth, thus allowing individuals to increase their net worth without incurring taxes. That concludes today's video. I hope it was informative and beneficial to you. If you found it helpful, please give it a thumbs up. I welcome your feedback, so feel free to share your thoughts in the comments section below. Lastly, remember to subscribe and turn on notifications so that you don't miss any future videos. Thank you for watching, and I'll see you in the next one.